picture this. You log into your brokerage account, the screen loads, and sitting right there in the middle of your portfolio is just a glaring sea of red.
Oh man, the absolute worst feeling.
Right, a 68% loss. That is a $10.6 thousand hole burned right into your capital.
Just brutal.
Yeah, for a lot of people, that is the kind of visceral financial pain that makes you, slam the laptop shut, delete the app from your phone, and just swear off the market entirely.
Oh, absolutely. It is a paralyzing moment for any investor. I mean, the instant is usually just a freeze, right? You hold on, you avert your eyes, and you just pray that the numbers miraculously bounce back so you don't have to actually admit defeat.
Exactly. But today, we're unpacking a masterclass in doing the exact opposite. We are doing a deep dive into this really fascinating piece of source material from March 2026.
Yeah, this is a great read.
It's a post by a retail investor who goes by the pen name The Fat Investor. And this is a former educator, someone with 2 decades of market experience. And he walks us through the exact anatomy of a major portfolio pivot.
Right. He details taking that massive $6K loss on a single stock, and this is the crazy part, using the remnants to fund this highly strategic buying spree into 3 global tech and healthcare titans, companies that he believes are currently sitting on the clearance rack.
And our mission today is to figure out how he did that and why.
Because what makes this analysis so compelling, it isn't just the specific stock picks. I mean, it is the underlying psychology of it all. We are looking at a real-time study in emotional discipline, the mechanical process of cutting losses and the ability to recognize structural macroeconomic shifts without letting your ego get in the way.
So let's start with the inciting incident here, the wreckage.
The trade desk.
Yeah, the trade desk. The investor decides to sell off his final tranche of this advertising technology company. He officially locks in that 68% loss. And reading through his post-mortem, I mean, it really reminded me of owning a heavily depreciated older car.
Oh, that's a good analogy.
Right. You keep pouring money into transmission fixes and new brakes because you vividly remember paying 40 grand for it brand new.
Yeah.
You're emotionally anchored to that original price tag. But the objective market reality, like the Kelley Blue Book value, says it is time to sell it for scrap. You just don't want to accept it.
Yeah, that is the sunk cost fallacy in a nutshell. We tether our current decisions to past expenses that we can literally never get back. But what stands out in the source is how this investor actually handled the sale.
He was weirdly calm about it.
Exactly. He notes that hitting the sell button felt entirely mechanical, like he had already processed the grief of losing the money the previous year.
He completely separated the financial transaction from the emotional reaction, which is so hard to do.
Sure.
But looking at the timeline, it makes me wonder about the specific catalyst. I mean, he held it all the way down to negative 68%. He could have sold at negative 30 or negative 50.
Right.
He clearly had a high tolerance for pain. So what does this all mean? Why sell now? Why pull the plug on the car today in March 2026?
Well, because the core thesis broke. It wasn't just price action anymore. The fundamental story of the company changed. In his writing, he details this mounting pile of red flags. First off, you have the Trade Desk's FY 2026 sales guidance plunging to just a 10% year-over-year growth rate.
Which, okay, 10% growth doesn't sound terrible for a normal company, but for a high-flying tech stock, that is a death knell, right?
Precisely. When a company is priced for hypergrowth, investors are paying a premium for a future that assumes, 20 or 30% compounding growth.
Yeah.
So when guidance decelerates to 10%, the entire valuation multiple compresses violently. The market just ruthlessly re-rates the stock.
Ouch.
Yeah. And then add to that a string of frequent executive turnover, which almost always signals internal instability. But the definitive final straw, the thing that really broke the camel's back, was a report regarding Publicis.
The global advertising agency, right? PubGY.
That's the one. A third-party consultant for Publicis reportedly found the Trade Desk in violation of its service agreement.
Now, to be fair, the Trade Desk did officially refute those claims. They pushed back hard on that.
They did.
But in the ad tech world, trust and contract integrity are the entire foundation of the business. I mean, even the appearance of a breach introduces this massive structural unknown.
Exactly. And this is a critical takeaway for you listening right now. This investor is not someone who just panics and sells at the first sign of volatility.
Right. He mentions holding other stuff.
Yeah, he explicitly notes his past successes in holding and even averaging down on companies like Shopify and AEM through severe temporary setbacks. He endured the pain there, and he was ultimately rewarded for his patience.
I noticed that. So the difference here isn't his risk tolerance. It's his clarity.
Bingo.
With Shopify, the macroeconomic environment was bad, but the company's core engine was still intact. He could clearly see the path forward. But with the Trade Desk, he writes that he no longer sees the clarity needed for a turnaround.
The story changed.
Yeah. It isn't that they are entirely incapable of recovering. It's just that the foundational reason he bought the stock in the first place is no longer valid. He recognized the difference between a stock taking a temporary breather and an investment thesis fundamentally breaking.
Yeah, at a certain point, putting more gas in the tank isn't going to fix a cracked engine block. You just have to sell it for scrap and reallocate those funds into a vehicle that actually runs.
Which perfectly brings us to the reallocation. Where does that salvaged TTD capital go next?
Somewhere much safer, hopefully.
Well, the investor decides to pivot away from broken stories and move toward exceptional companies that are just hitting temporary speed bumps. And his first stop is the undisputed leader in robotic surgery, Intuitive Surgical, ISRG.
A very strategic pivot, especially given the macro environment surrounding healthcare stocks recently.
And here's where it gets really interesting.
Okay.
For the last couple of years, the market has been completely obsessed with the narrative around weight loss drugs, the GLP-1 threat. The prevailing wisdom was that these revolutionary medications were going to completely hollow out the market for bariatric surgery. The logic seemed to sound right. If patients can just take a weekly medication to drop the weight, nobody is going to opt for an invasive stomach stapling procedure.
Makes sense on paper.
Exactly. Less surgery means less demand for Intuitive's robotic surgical systems. But the source reveals this major twist. The threat has actually morphed into a catalyst.
What's fascinating here is the evolution of the clinical data. Because instead of replacing surgery entirely, these drugs are increasingly acting as a preoperative tool.
Wait, really? A pre-op tool?
Yeah, consider the mechanics of it. You have patients with extremely high BMIs who were previously deemed way too high risk to safely undergo general anesthesia and surgery. Their bodies simply couldn't handle the strain.
So they were entirely locked out of the surgical market to begin with.
Exactly. They weren't even customers. But now doctors are prescribing these GLP-1 medications to help those specific high-risk patients drop enough initial weight so their cardiovascular systems can actually safely handle the anesthesia.
Oh, wow.
Right. And once they qualify, they undergo the robotic bariatric procedures for a more permanent solution. So the addressable market didn't disappear. In some vital segments, the medication actually unlocked a demographic of previously inoperable patients.
That is wild. But despite that synergy, Intuitive stock is currently taking a total beating. I mean, they are down over 15% this year.
Yeah, they are.
And looking at their FY 2025 numbers, that drop seems completely disconnected from reality. They breached the $10 billion revenue mark for the first time. Their earnings per share hit $8. They placed 870 of their new Da Vinci 5 systems, which is more than double what they managed the previous year.
Hospitals are clearly buying the hardware.
Hand over fist. Yet the market is punishing them because management issued this conservative outlook for 2026. They warned that new supply chain costs and tariffs, I think it was a 1.2% tariff headwind, are going to take a temporary bite out of their gross margins, dropping them to around 67 or 68%. And procedure growth might slow down just a bit to 13 to 15%.
The market is just notoriously short-sighted when it comes to high-premium stocks. When a company is priced for absolute flawless execution, any slight moderation in growth, even a self-imposed conservative forecast from management, triggers a massive valuation reset.
But I want to push back on the investor's logic here for a second. Is this really a clearance rack stock?
Why wouldn't it be?
Well, even after dropping 15%, Intuitive is still trading at a forward price-to-earnings ratio of roughly 47x to 50x, and their trailing PE is like 60x. How on earth does our investor look at a company trading at 50 times forward earnings and confidently call it a stock on sale?
Sounds crazy.
To the average person, that sounds wildly expensive.
Optically, a 50 times multiple does sound steep. But what's fascinating here is you have to look at the mechanics of their specific business model. It's not just a hardware company that sells a robot once and never sees the customer again.
Right.
You are paying for a high-margin utility. 84% of Intuitive's revenue is recurring.
84%?
Yeah.
Just from the instruments?
Right. It is a razor and blade model on an industrial medical scale. Every single time a surgeon uses a Da Vinci robot, the hospital has to buy new proprietary surgical instruments, new accessories, and they have to maintain these expensive service contracts. The hardware is just the Trojan horse to get the recurring revenue stream into the operating room.
Okay, so the floor is exceptionally stable, the revenue repeats. But a 50 multiple still implies massive future growth. Where is the upside coming from to justify that kind of premium?
Well, the source outlines several major future drivers that the market is just completely ignoring in its panic over short-term profit margins. First, ambulatory surgery centers, or ASCs. Basically, think of these as smaller day surgery clinics operating outside of traditional massive hospital networks in the U.S.
But smaller clinics usually can't afford multi-million-dollar robotic systems, can they?
Historically, no. But Intuitive is aggressively capturing this trend by utilizing extended use programs for their older generation systems. So by increasing the lifespan of certain instruments, they significantly lower the per procedure cost, making it financially viable for these smaller clinics to finally adopt robotics.
Oh, clever.
Very. Second, there is profound international momentum.
Yeah.
Outside the US or OUS sales now make up 35% of total revenue. The runway abroad is actually way longer than in the States.
And the source mentions a wild card regarding cardiac procedures too, right?
Oh, a huge one. In January 2026, the FDA cleared their newest system for a broad range of cardiac procedures.
Wow.
Yeah, including mitral valve repair. That opens up a monumental addressable market previously dominated by highly invasive open chest surgeries.
So the investor's thesis is pretty simple. You endure the temporary margin squeeze and the tariff noise today, because by 2027, the sheer volume of cardiac procedures and international expansion will force the market to pay a premium all over again.
Exactly.
Intuitive is basically a physical toll booth inside the hospital, which perfectly bridges the gap to the ultimate digital toll booth, Microsoft.
The big one.
Yeah, that is the second place our investor deploys his salvage capital.
Microsoft is the absolute backbone of the global corporate infrastructure. But much like Intuitive, it is currently navigating a very rare valuation correction.
And the disconnect here is just staggering. Microsoft just reported their first half of FY 2026, and the numbers are astronomical. $159 billion in revenue.
Insane numbers.
Q2 earnings of $4.14 per share. They beat expectations across the board. Yet the stock has completely cratered. It slid more than 20% year-to-date from its high of $560.
It's wild.
Okay, let's unpack this. Imagine there is a wildly successful restaurant in your neighborhood. There is a line around the block every single night, the cash register is overflowing, the reviews are flawless. But suddenly, all the financial backers start panicking and selling their shares.
Why?
Because the owner just announced he is spending his entire life savings to build a colossal, highly experimental, futuristic kitchen in the back.
That is the perfect analogy for the current market sentiment around Microsoft. That experimental kitchen is their capital expenditure bill for the AI arms race.
Yeah.
For FY 2026, Microsoft's projected capital expenditures are crossing the threshold of $110 billion.
$110 billion.
Yeah. Investors are terrified by the sheer scale of that spending.
Just on data centers and infrastructure to support artificial intelligence. That is a GDP-level expenditure.
And it isn't just the sticker shock that is spooking Wall Street. It is the shifting competitive landscape. The exclusive halo Microsoft enjoyed a year ago with their OpenAI partnership. It's fading.
Right.
OpenAI is reportedly exploring additional partnerships with Amazon. Meanwhile, rival models like Google's Gemini, Anthropic's Claude, and xAI's Grok are just rapidly eating into ChatGPT's mindshare. The market is looking at that $110 billion bill and asking, are you spending all this money just to tread water in an increasingly crowded pool?
Which brings up my absolute favorite detail from the entire source text. It perfectly highlights the absolute necessity of separating objective reality from subjective bias. The fat investor, the guy actually making these trades, explicitly states that he despises using Microsoft products.
I love this part.
He hates them. He is a die-hard Apple and Google ecosystem guy. He uses a Mac, an iPhone, the Google Productivity Suite. As a consumer, he wants absolutely nothing to do with Windows or Office.
Which provides such a brilliant lesson in behavioral finance. So many amateur investors fall into the trap of only buying what they personally use and love. They project their own consumer preferences onto the global market.
But he recognizes that his personal preference is totally irrelevant to the objective reality of enterprise demand. He notes that during his 20 years as an educator, he had absolutely no choice but to use the Microsoft Office suite.
Yep.
The corporate world is locked in.
Right. If we connect this to the bigger picture, it is all about switching costs. Imagine a Fortune 500 company trying to migrate 50,000 employees from Excel and Azure over to Google Sheets and Amazon Web Services.
Nightmare.
The productivity loss, the retraining costs, the IT friction, it is practically insurmountable. That friction is Microsoft's economic moat.
And the numbers prove it. You look at their intelligent cloud segment, it just crossed $50 billion in revenue for a single quarter. Azure, their cloud computing platform, grew by 39%.
So when the broader market panics over short-term AI spending and sends the stock sliding 20%, objective valuation takes the wheel. That drop reduced Microsoft's forward PE ratio to roughly 23x, which is well below its historical average.
Yeah.
At 23 times earnings, personal preference takes a back seat. You don't have to love the software to love the balance sheet.
Exactly. Now, Microsoft is punishing its stock price by spending $110 billion to build the future. But sometimes, the ultimate power move is refusing to spend a dime.
Let's look at the final reallocation target here, Netflix.
Netflix. The streaming wars have entered a highly strategic, very mature phase in 2026.
It has been absolute corporate drama. Back in January, Netflix was locked in this bidding war against Paramount Skydance, PKSY, over the acquisition of Warner Bros. Discovery, WBD. And the financial media was just in a frenzy over it.
Oh, they loved it. Ultimately, the headlines read that Netflix lost the bid to Paramount. I remember reading those articles, And the media spun it as Netflix losing their edge like they couldn't afford to play in the big leagues anymore. They looked weak. But looking at the actual numbers in this deep dive, it seems like they intentionally dodged a massive bullet.
That media narrative completely missed the financial reality of the situation. In massive M&A deals, there is a concept known as the winner's curse.
Right.
The company that wins the bidding war often overpays so severely that they end up destroying their own shareholder value in the process.
Wow.
Yeah. So by walking away from this optional acquisition, Netflix executed a masterclass in addition by subtraction.
Okay, explain that though. How exactly does losing a major asset make a company a winner?
Well, if we connect this to the bigger picture, first, they avoided saddling their balance sheet with an absolutely staggering $60 billion debt load from Warner Bros. Discovery.
60 billion.
Yeah, $60 billion. Taking on that kind of debt completely transforms the DNA of a company. Instead of being an agile, cash flow, positive tech company, Netflix would have morphed into a debt-servicing legacy media conglomerate. They would have spent the next 5 years just paying down interest.
And the structure of the deal was such that by walking away, Netflix didn't just avoid the debt, they actually triggered a windfall. They walked away with a $2.8 billion termination fee.
Yep.
They literally got paid nearly $3 billion to not buy a company and not take on debt.
It's brilliant. It frees up their executive management team to maintain a laser focus on what actually drives their profit margins, which is producing original, must-watch content and rapidly scaling their new advertising tier. They aren't distracted by a messy, multi-year corporate integration.
And the financial reality reflects that operational clarity right now. The stock has rebounded nicely from its recent lows of $75 up to around $90.
Nice little pop.
Yeah, but even with that pop, the valuation is compelling. They were trading at about a forward PE of 30x. But when you factor in how fast those earnings are projected to grow, largely thanks to the ad tier, their PEG ratio is just 1.3x.
Which is incredibly reasonable.
Right. So when you zoom out and look at all three of these moves, Intuitive, Microsoft, Netflix, you see a very clear philosophy emerging from the source material. The investor calls it small moves, big picture.
I like that.
Because he took such a severe loss on the trade desk, the actual dollar amounts going into these new positions are currently tiny. Intuitive makes up just 1.8% of his total portfolio. Microsoft and Netflix are barely 1.1% each.
And, to a lot of people, that might feel completely pointless. Why even bother researching and reallocating such a small amount of salvaged cash? Feels like trying to put out a forest fire with a squirt gun.
Exactly. Why bother?
Because wealth isn't built in a single dramatic trade. The cumulative effect of constantly pruning your dead branches and reallocating even tiny amounts of dead capital into dominant, structurally sound market leaders, it pays off exponentially over decades. Those 1% positions, allowed to compound within incredibly strong companies, could easily become the foundational pillars of his portfolio 5 or 10 years from now.
And that brings us all the way back to you, listening right now. The greatest takeaway here is that you do not need to be a Wall Street insider with access to supercomputers to make smart moves. Whether you are navigating your own investment portfolio, running a business, or just trying to manage your career path, success is rarely about never making a mistake.
Mistakes are inevitable.
You will buy a stock at the wrong time. You will launch a project that fails.
Right. What defines your long-term trajectory is your mechanical discipline. Do you have the emotional regulation to recognize when your core thesis has fundamentally broken and the courage to actually cut your losses? And equally important, do you have the patience and the clarity to buy quality when everyone else is running for the exits in a panic?
It is entirely about untethering your ego from your past decisions. We spend so much time talking about how to cut our losers, but I want to leave you with a different question to mull over. Look at your own life, whether it's your portfolio, a project at work, or even just a habit. What is your trade desk? What sunk cost are you holding on to right now that you need to mechanically cut so you can reallocate that energy into your own Microsoft or Netflix?